Have you ever wondered if you can write off your car payments from your taxes? It's a question that pops up in the minds of many, especially those who use their vehicles for business purposes. The answer isn't as straightforward as a simple yes or no, but rather, it's a bit of both. You see, the general rule of thumb for deducting vehicle expenses is that you can write off the portion of your expenses used for business. This means that you cannot deduct your entire monthly car payment from your taxes as a business expense. However, don't let that discourage you. The silver lining is this: you will still be able to write off a percentage of your car and truck expenses. This can significantly lower your taxable income, making a considerable difference in your bottom line. So, while you cannot deduct the entire monthly car payment from your taxes as a business expense, you can still write off a percentage of your car and truck expenses. Let's delve deeper and understand the actual expenses method. This approach requires you to keep tabs on every penny you spend on the business use of your vehicle. It might sound like a headache, but trust me, it's not as hard as it seems. With apps like Bonsai Tax, you can make tracking receipts a breeze. This software scans your bank and credit card receipts, identifying potential business expenses you can deduct from your taxes. Now, why would you want to go through all this trouble? Well, it's simple. The actual expenses method can save business owners and independent contractors a substantial amount of money when tax time rolls around. It's all about reducing that taxable income, my friends. Let's break it down a bit. The expenses you can deduct from your taxes include parking fees, gasoline expenses, oil changes, vehicle repairs, tire replacements, and even the interest on a loan for a car you use in your business. Yes, you heard that right. Other deductible costs include vehicle insurance as a business expense, license costs, registration fees, and vehicle depreciation write-offs. If you lease your car, you can even include the auto loan lease payment. Now, don't get too excited about that depreciation write-off just yet. There are some limits to consider. For instance, Congress has put a cap on the first-year depreciation deduction one can claim. You're looking at a maximum of $10,200, plus an $8,000 bonus depreciation. But it's not all doom and gloom. The actual expense calculation, or AEC, provides a massive incentive for companies or partnerships to upgrade their owned fleets. By deducting 100% of the cost using the bonus depreciation in year one, businesses can save big, especially when opting for certain business-dedicated model SUVs, trucks, and crossovers with loaded vehicle weights between 6,000 and 14,000 pounds. The actual expenses method generally saves business owners and independent contractors more money at the end of the tax year. You might be wondering, what are the actual expenses you can deduct? Well, let's dive into that. If you're using the actual expenses method, you'll be tracking and adding up all the money spent on the business use of your vehicle. This might seem like a lot of extra work, but trust me, it's worth it. And there are handy apps like Bonsai Tax that can make tracking receipts a breeze. Now let's talk about the business-related vehicle expenses you can deduct from your taxes. These include parking fees, gasoline expenses, oil changes, vehicle repairs, and tire replacement. You can even deduct interest on a loan for a car you use in your business. Other deductible expenses include vehicle insurance as a business expense, licenses costs, and registration fees. But wait, there's more. You can also write off vehicle depreciation. That's right. The value that your vehicle loses over time due to wear and tear can be deducted from your taxes. And if you're making auto loan lease payments, those can be written off as well. But remember, these deductions are only applicable if you're using your vehicle for business purposes. And the amount you can deduct is proportional to how much you use the vehicle for business. For instance, if you use your car 50% of the time for business, you can deduct 50% of these expenses. Keep in mind, the actual expenses method generally saves business owners and independent contractors more money at the end of the tax year. So it's definitely worth considering if you use your vehicle for business purposes. And that's it. Those are the business-related vehicle expenses you can write off from your taxes. So the next time you fill up your tank or get an oil change, remember, it might just be a deductible expense. Stay tuned for the next scene where we'll discuss depreciation considerations. We'll delve into how Congress has limited the first-year depreciation deduction and what that means for you. These are the business-related vehicle expenses you can write off from your taxes. Remember, every little bit helps when it comes to reducing your taxable income. So take full advantage of these deductions and save where you can. One crucial aspect to consider is vehicle depreciation. When it comes to the world of business expenses, the depreciation of your vehicle plays a significant role. Now you might be thinking, what is depreciation? In simple terms, it refers to the value your car loses over time due to wear and tear. This depreciation, believe it or not, can be written off as a business expense. However, it's not as straightforward as it sounds. Congress, in their infinite wisdom, caught onto this little trick a while back. They've put a cap on the first-year depreciation deduction one can claim. As of now, you're looking at a maximum of $10,200, plus an additional $8,000 bonus depreciation. It's not all you might hope for, but it's still a significant chunk of change. But that's not all. There's a silver lining for companies and partnerships that own their fleets. If you're in this category, you might be in for a treat. The Alternative Depreciation System, or ADS, calculation can provide a huge incentive for you to upgrade your fleet. Let's break it down. First off, you can deduct 100% of the cost using the bonus depreciation in the first year. That's a big incentive right there. Secondly, this applies to a range of vehicles, particularly business-dedicated models from 2021, including SUVs, trucks, and crossovers. And finally, this deduction is applicable for vehicles with loaded weights between 6,000 and 14,000 pounds. So, you see, there are quite a few perks when it comes to depreciation considerations. Whether you're a small business owner using your personal car for business trips or a large company with a fleet of vehicles, understanding vehicle depreciation and its tax implications can save you a pretty penny. However, remember that these calculations can get complex, and the rules can change. So, it's important to consult your tax advisor to assist with these calculations. They can help you navigate the murky waters of tax deductions and ensure you're making the most of your business expenses. So, it's important to consult your tax advisor to assist with these calculations. What if you lease your vehicle, you may ask? Let's dive into that. Leasing a vehicle is often a viable option for many businesses. It allows for the use of a car without the financial commitment of owning one. Now, if you lease your vehicle and choose to deduct actual vehicle expenses, there's a different set of rules to follow. One of the significant appeals for companies owning their vehicles is the potential for depreciation write-offs. Since 2019, a full deduction of the car price has been available for many vehicles. But here's the catch. If you lease your vehicles, this option isn't on the table. Instead, you can deduct the business portion of the lease, which brings us to a concept known as income inclusion. Income inclusion is a small amount of income that lessees must add back to their gross income when they lease a vehicle. The purpose is to equalize the tax benefits of leasing and owning business vehicles. Now, how does income inclusion work? It kicks in when the car's fair market value exceeds a certain threshold, updated annually by the IRS. If your leased vehicle falls into this category, you'll need to add a specific amount to your gross income, which reduces the lease payment deduction. So it's essential to keep in mind that while leasing a vehicle can provide certain tax advantages, it doesn't equate to a full car price deduction as with owned vehicles. However, it's crucial to note that the rules around leased vehicles and tax deductions can be complex, and it's always wise to seek advice from a tax professional. To summarize, if you lease your vehicles, you can't claim a full car price deduction. However, the business portion of the lease is deductible. You'll need to navigate the waters of income inclusion, but with the right guidance, you can still find significant tax advantages. So, while you can't claim 100% car price deduction with leased vehicles, the business portion of the lease is deductible. So, leasing could still be a smart move for your business. Now let's talk about the standard mileage rate deduction. The standard mileage rate method is a handy tool introduced by the Internal Revenue Service, or the IRS, to simplify the process of writing off vehicle expenses. No more meticulous tracking and recording of every dime you spend on your car for business. Instead, you simply keep a record of the miles you drive for business purposes. Think of it as a shortcut, a simple and efficient way to calculate your vehicle expenses for business use. It's especially useful for those who drive a lot for their business, but don't incur a ton of other vehicle-related expenses. But here's the catch. When you opt for the standard mileage rate method, you cannot also deduct actual car expenses separately. It's a one or the other scenario. This includes costs like maintenance and repairs, gasoline, insurance, and depreciation. However, there are 3 exceptions to this rule. Yes, you heard it right. 3 expenses that you can still deduct even if you're using the standard mileage rate. Firstly, business trip parking fees and tolls. These costs can be written off separately as they are considered necessary for your business operations. Secondly, if you paid a personal property tax when you purchased your car, based on its value, that's deductible as well. And lastly, if you took out a loan to buy your car, the interest on that loan can also be written off. Remember, the standard mileage rate method is all about simplifying the process. It's about making it easier for you to calculate and deduct your vehicle expenses for business use. But it's important to note that if you claim the standard mileage rate, you cannot use your lease payment as a deduction. So, to sum it all up, the standard mileage deduction method offers a simple way to calculate the business use of your vehicle expenses. It might not be the right fit for everyone, but for many, it's a convenient and hassle-free way to handle their vehicle-related tax deductions. Let's wrap up what we've learned today. We've navigated the ins and outs of deducting vehicle expenses from taxes, and it's clear that the rules can be nuanced and multifaceted. But don't worry, you're not alone in this journey. We're here to help you understand these complexities. We kicked off with the general rule of thumb, remember? You can't deduct your entire monthly car payment, but you can write off a portion of your car and truck expenses used for business purposes. This is a crucial distinction that can significantly lower your taxable income. Then we delved into the actual expenses method, which, despite seeming like a lot of extra work, can actually save you more money at the end of the tax year. With apps like Bonsai Tax, tracking and adding up all the money spent on the business use of your vehicle can be as easy as pie. We also broke down the list of business-related vehicle expenses you can deduct from your taxes. From parking fees to auto loan lease payments, there's a wide variety of expenses you can write off. Next, we explored depreciation considerations. Remember, the luxury consideration and the cap on first-year depreciation deduction. We also discussed the AEC calculation and the incentives it provides for companies to upgrade their fleets. When it comes to leased vehicles, we found out that while you can't get in on the 100% car price deduction, you can deduct the lease's business portion. This brings us to the concept of income inclusion. Finally, we introduced the standard mileage rate method, a simple and straightforward way to write off vehicle expenses. But remember, you can't deduct actual car expenses separately if you choose this method. So there you have it, folks. A comprehensive guide to how your car payments can indeed help you write off from your taxes. Remember, everyone's situation is unique, so it's always a good idea to consult with a tax advisor to make sure you're making the most of your deductions. If you found this video helpful, don't forget to like, subscribe, and share it with fellow entrepreneurs. Thanks for joining us today, and we'll catch you in the next video on building wealth.